Our next speaker is a familiar face. She was with St. Louis for about 5 years, and she's come back home. Lynn Reaser is the chief economist for Point Loma Nazarene University and the Fermium Business and Economic Institute. They engage in economic analysis, modeling, and forecasting, and recommendations for corporations, not-for-profits, and for government agencies. Lynn has extensive experience in the financial services sector. She was chief economist for Bank of America for about 10 years. And in that role, she provided global and U.S. economic framework investment strategy for institutional and brokerage clients. At Bank of America, she delivered about 100 client presentations a year, 200 to 600 media interviews, radio, TV, internet, you name it. Dr. Reaser received her bachelor's and master's and doctoral degree at UCLA in Los Angeles. And she's here today to give you her perspective on the economy and the markets.
Thank you very much, Julie, and good afternoon to all of you. Can you hear me all right in the back? It's a great honor to be on this panel this afternoon. And as I was hearing about the $100 drawing, it reminded me of a meeting recently that took place. In a dining room, sitting around a table, were a businessman, an economist, the Easter Bunny, and Santa Claus. And in the middle of the table, there was a $100 bill. Suddenly, the lights went out, and when they came back on, the $100 bill was gone. Question: who stole the $100 bill and why? Do you have an answer? Well, raise your hand or speak up. Alan, what do you think?
I don't know. I'm at a loss.
Julie? All right, somebody's got to have an answer. Who stole the $100 bill? The businessman. He was the only real person. This afternoon, the slides up here. Let me focus on 5 key topics. First, the global outlook. Second, the U.S. economy. Third, how we see financial markets. Fourth, the state here, Missouri and St. Louis. And then finally, fifth, how this should influence some of the things you might be thinking about in the next year. So first of all, in terms of the global outlook, following Alan's comments, it appears to us that the global economic recovery is underway. It has lost some momentum, as you can see in this chart, on global manufacturing activity. But with the line still above 50%, it still suggests that the world economy is moving forward. If you look at world trade, you can see the devastating impact of the severe recession of 2008, but the spring back in 2009, which began about the middle of last year, 2010, 2011, we expect this recovery to continue in terms of both world exports and imports. China remains key to the world economy, and although you've seen efforts of China to slow down some of the overheating taking place in the property market, I just returned from a trip in China leading a group of economists there this summer, and it's clear that the Chinese government is committed to keeping the Chinese motor going, and so we would expect growth to continue to be at around 9 and 9.5% during the years ahead in the near term. We had a big question about whether there were banks that were too big to fail, and then we also this spring discussed the question, were there countries that were too big to fail? And it turned out there were, and they actually were pretty small. Greece in particular turned out to be, even though a small country, too big to fail, and so there was a major rescue effort launched to prevent the Eurozone from collapsing. And so as we look at the world economy today, it appears that we're looking at a significant dichotomy in the world, with emerging markets in Latin America and Asia continuing to grow at about a 6% pace, while Europe, the US, Japan, the industrialized countries, continue at a much more moderate pace, but we still expect to continue to see growth this year and into 2011. The dollar has seen a significant decline in the last few years. We did see that bump up in 2008 with the flight to quality. And although the U.S. economy may not have looked that great, we basically were the least ugly girl at the dance. And so investors came to the dollar. But this year we've seen, of course, the continued decline in the dollar, and we would expect that to happen again in 2011. No dollar collapse, but clearly there are more attractive returns in emerging markets and countries that are starting now to raise their interest rates. Now, turning to the U.S. economy, as you know, the official arbiter of recessions and recoveries declared that the recession began at the end of 2007 and it ended in the middle of last year. So we have had a recovery going for about 15 months. But the question is, does it feel like a recovery? And I think that most people say, what recovery? It certainly doesn't feel like one. But nonetheless, most businessmen are seeing some recovery in their sales, some recovery in their businesses. And we would expect this recovery to continue through the remainder of this year into 2011. We're looking at fairly modest growth, 2.5% to 3% range, not enough to make a dramatic dent in unemployment, but at least a story of growth as opposed to recession. So I agree with Alan. It does not appear that we're headed towards the double dip scenario. If we compare the recoveries from deep recessions, generally it turns out to be the case when you have a deep downturn. It's like a rubber band. The deeper the way you pull the string in one direction, the sharper the snapback. But look at this particular recovery. In the first year and a half, we expect to see a much more muted recovery than you would generally anticipate. And why is this the case? Well, this recession was very different from the ones we have typically seen that have been caused by sky-high interest rates and Fed tightening fighting inflation. This recession came about because of a major financial crisis. And the work done by Carmen Reinhart and her associate, who wrote the book, This Time Will Be Different, she documents the fact that if you look at the aftermath of financial crises around the world, generally they are followed by subpar recoveries. So slower growth, lower inflation, higher unemployment. And the major reason is that it's just going to take some time for us to deleverage. Yes, we've done a lot of it in the part of consumers, but more still needs to be done. And although you can have a lot of government policies countering that impact, it may be the case that we just may have to let this deleveraging run its course. In terms of output, our forecast suggests that we actually will recover all of the lost output in terms of real GDP by the early part of next year. But employment will be a very different story. The big wave of layoffs is behind us, but companies are still cautious in hiring. It's not exactly clear why this caution prevails, but it's pretty evident if you survey most of them. It's a lack of confidence in sales activity, that the sales growth will be there, and it's also a lot of uncertainty about healthcare costs, about environmental cost, about government regulation. And so companies are just not willing to make the big investment to hire a lot of people. And as a result, we think the unemployment rate will only gradually move lower. We don't see it going back above 10%, but by the end of next year, it is still likely to be above 9%. Is the bigger threat inflation or deflation? I think in the near term, neither will be the case, but rather a slow increase in consumer prices, still positive. I think in the near term, the bigger risk might be deflation that the Federal Reserve is worried about. But I would agree with Alan, probably the longer term risk is more inflation. But I think in the next 15 months, basically the overall rate of inflation will be fairly moderate at around 2%. Now, turning to the third issue, financial markets, will the bulls or the bears prevail? The big story recently has been talk of quantitative easing, by which the Federal Reserve would buy massive amounts of Treasury securities. Here you can see the trend of the Federal Reserve's balance sheet. It is now ballooned to $2.3 trillion. And as Alan suggests, when you're talking $1 trillion, you're talking about real money. And there is speculation on Wall Street, how much will the Federal Reserve buy? Is it going to be $500 billion, $1 trillion over the next year? But it appears that the Federal Reserve, probably in early November, will go forward with additional Treasury purchases. What they're trying to do, push down long-term interest rates for businesses and mortgage purchasers, trying to give the economy a little bit of lift, encouraging investors to take a little more risk. Will it work? My view is that this economy's major problem is not a lack of liquidity, not a level of interest rates that is too high, but I think nevertheless the Federal Reserve probably will go forward and will be buying these significant amounts of Treasury assets. The outlook for interest rates, again, in the near term, I think interest rates are, in terms of short-term rates, the Federal Reserve has taken the federal funds rate down to 0 to a quarter percentage point, and it would appear that they're going to keep that rate low for a number of months. Probably the soonest they'd be raising rates at the end of next year, and at that point only by a small amount. Long-term interest rates, if you look at the 10-year Treasury note yield, have come down dramatically. They're around 2.5%. They could fall even further with the purchases going forward. But I think by the end of next year, markets will start to get wind of the fact that the Fed Reserve will ultimately be exiting out of this easy money strategy. We'll be facing a significant federal budget deficit. And so I think a year from now, you will be looking at longer-term interest rates in particular moving higher, not skyrocketing, but higher than today's level. Profits have been a very good story this year. If you look at the earnings that have been reported for the third quarter, they've been generally beating expectations. That's helped the stock market move forward. Companies have repaired their balance sheets. They are generally quite healthy. And as a result, I think in terms of investment strategy, now is probably the time to be tilting your portfolio somewhat away from bonds, which are now beginning to look a little less attractive as the Federal Reserve has pushed interest rates pretty low, and be shifting a little more towards the equity picture. This is a fairly happy scenario in terms of economic growth, not robust, but continuing, fairly low inflation, fairly low interest rates. But what are the potholes? There's plenty of things that can go wrong with this scenario, but I think one, as Alan suggested, is a pretty great certainty, is the federal budget deficit issue. The fiscal year that just ended at the end of September, we did show a little bit of reduction in our federal budget deficit from $1.4 trillion to $1.3 trillion, amazing progress, but we're still running large deficits. And if you look at our debt, it's continuing to increase. The two lines on this chart are pretty compelling. The bottom line is done by the Congressional Budget Office, the ratio of our debt to GDP. The Congressional Budget Office assumes that current law remains in effect, so that it assumes that all the tax cuts will expire. The top line is done by a couple of individuals, Auerbach and Gale, and they sketch the scenario where Congress basically acts as it usually does. It allows all these temporary tax cuts, et cetera, to continue. And if you do that analysis, the debt-GDP ratio surpasses its World War II high of around 109% in just 12 years, and the ratio turns to absolutely astronomical levels towards the end of the century, with the debt-GDP ratio reaching something like 1,000%. So if anyone planning on leave, I know we have a number of high school students, you're all planning on being around here by 2080. You may not want to when you see this chart. And the question is, do we get a political solution first to this, or do we get a market solution? I'm hoping we get a political solution. The market solution could look fairly ugly in terms of sharply higher interest rates or a weaker value of the dollar. Turning to what this means to St. Louis and Missouri, if you look at the chart showing the year-to-year changes in employment, what you see here is that Missouri has pretty much bottomed along with the rest of the country. We kind of actually went into the recession at the same point, but we've come out and we're actually doing a little bit better than the nation as a whole. St. Louis is actually doing quite a bit better, whereas the nation is showing just a very tiny increase above a year ago in terms of jobs. St. Louis is actually seeing job growth year to year of around 1%. So not spectacular, but we're actually outperforming the rest of the country and the state. If you look at the overall level of jobs, here you can see that in St. Louis, we actually have been adding more jobs since the year began. And we've actually, in the greater metropolitan area, added nearly 20,000 jobs since 2010 began. So again, it doesn't feel great around here, but we've added about 20,000 jobs. Now, what about the housing market? Here you can see the jobless rate first. You can see in terms of the jobless rate, we pretty much bracket the nation in St. Louis and the state. The nation's around 9.5%. We're a little bit lower in the state, a little bit higher in St. Louis. So this jobless rate is still hanging around that 9.5% level, and it also will be only gradually moving lower. The housing market, this shows the year-to-year change in housing prices. You're all looking at this chart and looking at when you bought your house. And what you see here is that home prices are still falling. They're down about 5% year on year. So it doesn't look like we've actually bottomed out in terms of the housing market. It probably will be another year before we actually see home prices start to gradually move higher. In terms of the balance sheet facing the state and the metropolitan area, on the positive side, agribusiness is really strong here in the state. We see the benefits of a lot of economic diversity, particularly here in St. Louis. There are selected manufacturers that have found good niches, for instance, in primary metals, electronics, private education, big growth area, and healthcare. Also, our front tables here are really helping the economy. On the constraints, state and local budget pressure is still hurting. Commercial real estate will be an albatross around our neck for the next year. And really the big question mark, all relating to business uncertainty, something that we see throughout the country. So to recap, we're looking at a world recovery that's pretty uneven, but we do see moderate growth in the U.S., pretty low inflation, interest rates, and I think St. Louis and Missouri will be continuing to recover, with St. Louis actually outperforming the rest of the country. Our projections, you'll see a summary later on, but in terms of the implications, how should you run your institution given this kind of economic forecast? A few things. One, I think it's a great time to lock in long-term financing. Rates may go down a little bit, but we're probably going to be looking at higher rates a year from today. Second, as an investor, I think tilting somewhat away from bonds to equities at this point. Third, we don't know exactly what's going to happen to taxes, whether Congress will renew the tax cuts or what, but I think given that uncertainty, you probably want to move any income you can from next year to this year, so full employment for tax accountants in the year ahead. Fourth, if you're not using Twitter and Facebook, you are not with it. So get with your children. These are the opportunities for business marketing. It's not by traditional marketing anymore. You've got to be on these sites. You're not going to get your market. And finally, fifth, as Alan suggested, it probably doesn't make sense to wait for a major government program or action to help you in the next year. It doesn't make sense to wait for the economy to suddenly snap out of its doldrums. That's not going to probably happen. What will make a difference, though, is basically looking at your own business strategy. What business are you really in? What is your market? Are you going to be around in 5 years? And if you are, now is probably a great time to be investing in your business, investing in your people, because if you look at the track record, the periods of economic stress are often the times where businesses can make the biggest increases in their market share and really make their economic mark. Thank you very much.